Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, today we're going to talk about interest rates, home price forecasts, a bunch of economic data for basically national, the whole real estate market. We got a bunch of data from NAR and some other articles that just came out pretty recently. But Juana, before we get started, tell everybody about our new special deal with viewers who watch the channel.
Okay, so if you watch our videos within the first 48 hours, there will not be any commercials. If there are commercials, you need to tell us because they're not supposed to be any. And if you watch after the first 48 hours and somebody has forgotten to turn the commercials on, you may still watch them without commercials.
Yeah.
But if somebody remembers to turn the commercial on, then you'll get commercials. So the point is, watch the videos early, have a good time, enjoy them. Remember to like them, subscribe, hit the notification bell, leave us real estate related comments, and now enjoy the video. Here we go.
Okay, so the Juana and I research, we read a bunch of articles about real estate, and they're not all like Pollyanna. Some are super negative, some of them just have bad data. So we kind of grab random stuff from different articles. But this one caught my eye. This is from NAR. It was from Lawrence Yun, who's chief economist. And the title of the article was Things Are Looking Up. Now, my first gut reaction was, wait, are things bad? Because why would you say, normally when you say things are looking up, things are bad. But things really aren't that bad, right?
Correct.
In general.
Correct.
What do you think mindset-wise? Because people are used to home prices going up 5%, 6% a year, houses flying off the market, no inventory. We've gone back to normal, but people think that's bad because all they're comparing is to when it was super hot.
So it's interesting that you're bringing that up because I had this conversation with somebody yesterday. And the conversation went something along these lines. This person was kind of, to your point, was talking about the market being bad because homes aren't selling.
In 2 days.
Right. And so that was kind of the conversation we were having. And I just kind of sat there and I said, well, now wait a minute. How long are homes taking to sell? Oh, they're taking 2 or 3 months. And I said, well, that still makes it a seller's market, right?
Mm-hmm.
Because a normal market is an even market. An even market tends to be about 6 months. And if you're wondering, well, how did we come up with that? Well, let me give you an example. Most listing agreements, right? Most listing agreements where you're listing your home for sale are for a year. Well, what would be the reason that we would list a home for a year if it's going to sell in 30 days, 60 days? That wouldn't make sense. Well, the reason we sell homes for a year, because on average, homes take 6 months to sell in a normal market. Now, average means that half of them sell in less than 6 months and half sell in more than 6 months, which is why brokers list homes for a year. So kind of going back to my conversation with this person, I said, well, right now we're about 3 months, 4 months to sell a home. So we're still in a seller's market. Once we get to 6 months, then we're kind of even. Once we cross the 6 month mark, then it becomes a true buyer's market. Now, does that apply to every home? Of course not. Every home is unique and every home has a special buyer. So some homes, even in a hot market, never find their special buyer. And some homes find their special buyer right away, no matter what kind of market it is. So every home is unique, but we're looking at, statistically speaking, how long does it take to sell homes, and how does that reflect in the market?
Let me give you a perspective on this. Back in 2003, 4, 5, 6, when I first got into real estate, I got most of my listings from something called expired listings. Mm-hmm. So what I would do is I would call, and a lot of agents would take 6 months listings. 30 to 40% of listings would expire after 6 months. Mm-hmm. They just didn't sell. So I would call these people literally the day the listing expired. I would call them all to try to meet with them and find out why their listing didn't sell. And it was very common for that time. We haven't seen that. We had a listing expire in the last 5 years?
No.
Okay. And so in all our listings are in a year. We've taken 6 month listings.
It's pretty rare.
Pretty rare. Okay. So anyway, we're back to a normal market. What's interesting though was this quote. Now I read 3 different articles that talked about what's expected with home prices. Mm-hmm. One was Redfin. One was Realtor.com, and the other was Zillow. Mm-hmm. Okay, this is from Realtor. Mm-hmm. Okay, Lawrence Yun. With rates and prices stabilizing, Home sales will continue the upward trajectory that started in the final months of 2024. They're predicting home prices to go up. Realtor.com is predicting between now and December, or not Realtor, but Zillow minus 1%, and I think Redfin like minus 1.2%. So what they're saying is nobody really has a clue, but they don't think they're going to go up super high. They don't think they're going to go down quite a bit. I thought that was interesting. What do you think this is based on? Like, why do you think they're having such a hard time? Because to me, this is a breakdown in forecasting. We've done a better job forecasting the last 5 years. I think this year they're just kind of like have thrown their hands up a little bit.
Right. So we kind of talked about this before. A lot of this has to do with there is so much noise, okay? That it's very difficult to, parcel out the noise from the signal. So because there is so much noise and everything is moving so fast, but just because it's moving fast doesn't mean it's making progress. Not the same thing, right? Making great speed, but not in the right direction kind of thing. So I think that's what's going on. There's a lot going on economically. There's a lot going on nationally. There's a lot going on internationally. There's a lot of policy uncertainty. So there are a lot of things going on. I think that by the end of the summer, things will settle out a lot, particularly right now as they get through the whole budget. House passed the budget. We need the Senate to pass the budget. Then they'll do reconciliation. So once all that kind of gets settled out, I think it will help a lot because it will give the markets more certainty, and then it will give the Fed more certainty, and that will translate into rates kind of settling in wherever they're going to settle in, and then that will translate into more certainty in the housing market because now people will know, well, okay, rates are going to do this for the next foreseeable future because this is where we are, and so now people can make better plans. I think the issue is kind of like, people are trying to time the market, whether it's real estate or crypto or stocks or whatever it is. It's kind of the same thing. There's just a lot of moving pieces, and they're trying to just nail it just so. And that's very difficult to do, if not impossible.
And it's impossible to do in real estate because of the transaction costs of going in and out. It's not like E-Trade, we can click on a button and it sells, or like Coinbase, you can just sell your crypto. Here's another thing, because we're going to talk about interest rates, have a bunch of data on that. In markets that tend to go up, Bitcoin, we'll just say Bitcoin, and real estate and stock market, the downs are always covered by a couple ups. So if you're waiting for the big down, it almost never happens because you go, oh, it's down a little bit, I'll wait, and then it goes up 2 or 3%, and then it goes down 1% and it goes up 2 or 3%. So you're trying to like chase these. I'm going to wait to acquire a house. So Wanda, what about the people who in 2019 said, I think home prices are going to fall substantially, I'll just wait to buy a house, when they could have bought a house for, I think median homes at the time were 230 grand. They're over 400 now. And interest rates were like 3%. Now they're over 6%.
Right. So again, we're talking about timing the market. It doesn't really work. The other thing to keep in mind is that whatever the market's doing is not relative to your home that you're selling or to the home that you're trying to buy, because each home is unique in its own way. It might be cookie cutter for your neighborhood or for your community, and that's great. But realistically, there's the perfect buyer out there and there's the perfect seller out there, and trying to get them together isn't always necessarily the timings don't always match, right? So when you find that home that you've been looking for in that neighborhood that you've really wanted to get into, does it really matter what the market's doing, or does it matter that you finally found the home, that you found the one, right? So I think timing the market doesn't make a lot of sense. I think buying and selling when it's right for you makes all the sense in the world.
Okay, here's some mortgage rate sort of forecasts. Quote from the article: the high mortgage rates of 7 and 8% are over. The Fed will make further rate cut decisions in 2025 to move toward non-restrictive money policy. That's because the overall consumer price inflation, which the Fed constantly mentions as its top goal, will be contained. Now, rents have basically stabilized. A lot of the inflation numbers, some of them are showing below 2%. They're definitely below 3%. Talk about a recession. If we get into an actual recession, because people say, Todd, the recession will crash the housing market because the foreclosures will happen immediately. What generally happens with interest rates during a recession?
Okay, so two things. I want to address what you said first. You were talking about housing and inflation and rents. So let's face it, most of the rents actually come from apartments.
Okay.
Okay, so we've had a lot of apartments come online, and so that's the reason that rent prices have stabilized. And so that is a huge part of the inflation number. And so for that reason, inflation is probably a lot better than what maybe some people think it is. And remember, those numbers lag because of the way that they survey those numbers. And they lag by many, many months. So you're going to see that, and that's what I said. By the end of the summer, you're going to see a whole different picture. So a lot of things are going to fall into place by then. So that's the one thing that I wanted to cover as far as rents and inflation. And then the question 8 asked, what does real estate do during a recession? Well, we know that 6 out of the 8 last recessions that we've had, real estate prices went up, and they didn't go up by a bit. They went up by quite a bit.
Yep.
They actually were a great place to park money because homes appreciated. That doesn't mean that happens every time, but it does happen more than a majority of the time.
Mm-hmm.
So looking at that historically would lead us to believe that real estate, again, would participate in a favorable way in a recession versus other types of assets.
I'm going to put this chart up again. This is the Fred chart for total number of actual foreclosures, and this is the basically delinquency rate. This is current as of the first quarter of 2025. This is measured on a quarterly basis. It even says on there updated May 21st, 2025. The foreclosure rate, as you can see on this chart, is at near historical all-time lows. We're nowhere near any sort of type of massive foreclosures. They're the people who keep saying the foreclosure rate, and we just did a video on this where some crash bro said there's 6 million FHA loans that are all getting ready to be foreclosed, and that's absolutely fake.
Okay, so I want to touch on that for a minute. So what's the reason why we don't have a lot of foreclosures? Well, first of all, people have a lot of equity, right? So when people have equity, what are they able to do? They're able to sell the property before it gets foreclosed. So that's a huge reason. So not only are people able to sell the property, but there are buyers for those properties. So who are those buyers? Well, these buyers are a variety of people. These buyers are maybe owner-occupants in some cases. In other cases, these are investors. So look, investors have not disappeared. Flippers have not disappeared. They're out there and they're buying these homes. Now, are they paying full market value for them? Maybe, maybe not. But they are buying them, so it is making the difference regarding foreclosures. So if you're waiting for that foreclosure to show up on whatever website you're tracking with foreclosures, you might not get that house after all. That house may show up on the courthouse steps, and that's really highly unlikely. Most of them do not. Most of them are sold in the private market, whether they're to an owner-occupant or an investor, but they are sold before foreclosure. The lender is made whole, and everybody goes forward. And hopefully that seller is able to walk away with some equity versus nothing.
Also, legislation that was passed during the housing crash, after the housing crash, has stopped any of that kind of nonsense from happening again. Massive foreclosures.
Right. So massive foreclosures are in no one's interest, and they're not happening.
Right. Okay. We just got this data. As you can see in here, it says 5 data rates as of May 27th. These are current market rates. So we've got the loan type, the current rate, and then points. We'll talk about points in a second. Okay, 30-year fixed, basically called 6.5%, 6.49%. A jumbo, and that's the Fannie and Freddie conforming. Jumbo 30-year fixed, 6.5%, which is pretty good. That means you could buy $1.3 million loan on maybe a $2 million house, and you can still get a 6.5% rate. FHA 30-year fixed, 5.99, so just under 6%, and a VA is at 5.75. Now, Juana, you've got these points over here, and that's percent. What is a point? If you're buying a $400,000 house and you have 2 points, let's say the loan is $400,000 and you have to pay 2 points, how much do you have to pay, and what is that for? $8,000. And what is that for?
To buy down your rate.
Okay.
So what it is you're basically you're buying down the rate so that you're actually compensating the lender for giving you a lower interest rate.
Let's say you're going to buy a house, $400,000 loan, $450 purchase price. You're putting $50,000 down, but you want to get this rate, but you don't want to pay the $8,000 in points. Can you ask the seller to pay the points just as part of the deal?
Sure. So sellers can pay all kinds of costs on on behalf of the buyer. So, for example, sellers can pay closing costs, which would include points. Sellers can pay some portion of the buyer's agent's compensation, or all of it.
Yep.
Sellers can prepay property taxes for the buyer. They can prepay all kinds of things. Generally, what limits a seller's contribution is not the seller's generosity, but rather the loan program of the borrower.
The other thing that's not on here are 15-year fixed. We saw VA 15-year fixed, and of course, VA is anyone who's a veteran. I, of course, can get a VA loan as a veteran. 5.25% for a 15-year. The payment's more because it's amortized over less years. So I thought that was interesting. Now, here's some other very interesting data. This is a Housing Outlook that was published by NAR. They're predicting a 7 to 12% year-to-year increase in home sales. This is not home prices.
So
what does this mean?
These are homes that are turning, right? These are transactions. So what that means is that real estate agents are in business because they get to participate in most of these transactions.
So they're saying it's going to go from like 4.06 million homes a year to maybe 4.4, 4.5 million homes.
Right, but these are resale. These do not include new home sales. New home sales, we're probably looking at just shy of 1 million this year.
They're also estimating interest rates will be about 6%. As you just saw, if you get some products will be more than 6, some like VA will be less, and 15 years will probably be even less than that. The other thing that was interesting here was they forecast the national median home sale price up 2%. Like I said, they're guessing, they don't really know. A lot's going to change. Now remember, a lot of this is they're thinking borrowing costs will decline because of what the Fed will do, but then there's government spending, which is higher, and then there's the bond market, which is higher because of the debt and everything. So we don't really know. Also they're saying there'll be in 2026, there'll be a 10 to 15% increase, and then home prices will be 420 up there. So they're predicting 2% this year, 2% next year, and home prices will keep increasing, the home sales, number of homes that sell will keep increasing. They're also projecting 2 million more jobs, which is pretty substantial. 2 million net more jobs than we have, because we're not going to build 2 million more homes probably in the next 2 years, net new homes.
No, net new homes, no. That's not physically possible.
Not physically possible. Because remember, usually about 125,000 homes a year have to be built just to replace homes that have burned down, flooded, things like that.
Yeah.
Okay. Now here's the last chart. This is kind of a good one here. This is the unemployment rate. This is civilian unemployment rate. It doesn't include government workers, okay? Civilian unemployment rate, as you can see, we are near extreme historic lows. They're projecting, 4.3, 4.4% unemployment, which is historically considered pretty close to full employment. As you can see in COVID, it was much higher. Most of the last decade, 2013, 14, 15, 16, 17, it was same or higher. We didn't have housing crashes back then. Matter of fact, home prices were going up back then. So we don't really have this existential threat for unemployment. If the economy starts to go south, interest rates Fed will probably drop rates for the economic growth if they can. And we have probably no overbuilding in new homes. We don't have high unemployment. We don't have foreclosures. So when I see the crash bros that are regurgitating the same information since 2019, they got it wrong. 2019, 20, 21. 22, interest rates doubled, and they go, oh my God, that's 50% price decline. We've been at 3 years now with interest rates 6, 7%, and home prices have gone up since 20. There was a slight decline from spring to fall, and that was only because of the bump in the spring of home prices going up because people are overbidding to lock in these sub 5% rates before they went away. Without that, home prices basically have gone up since 2019, year over year, every single year. I don't think that's going to keep happening. I kind of agree with the plus or minus 1%. My gut belief is if you have a house you need to sell, we've had a couple people come to us. We're getting out of Vegas. We want to sell our investment properties or whatever. We're downsizing, and they're selling the home, right? We haven't had anybody say, in the last couple years. We think the whole housing market's going to crash, so we want to sell the house before and then buy it back in a couple years at half the price. No one's ever, has anyone said that to us?
No.
Okay. What's your sort of overview on all this that we just covered?
I think that the real estate market for residential is going to be relatively flat this year,
Right.
for a lot of reasons that I already mentioned. I think next year it's more likely than not that things will pick up as far as appreciation.
Right.
I think the number of transactions is going to continue to probably increase throughout this year and just kind of continue to increase as time goes by, if for no other reason than just household formations.
Yeah.
If for no other reason, forget, people trying to make money through real estate, but just household formations, just people needing a home to live in.
I've got great demographic data. We're going to make a video about this that shows the massive number of Gen Z millennials that are forming households at a far greater rate than boomers are dying. Mm-hmm. And it's creating a huge, and these are the highest earning cohorts ever for their age. Mm-hmm. So I think that's going to be interesting to watch over the next 10 years as these people that are making a ton of money coming in the real estate market that now are used to 6-7% rates. When they see 5.5, 5, they may jump in and spur more purchasing.
Yeah, so I think that's a lot of what's going to happen. But time will tell, right. And if you hang out with us and keep watching the channel, then you'll find out with us.
Yep.
So please remember to like the video, subscribe, hit the notification bell, share the video, leave us your real estate related comments. Watch within the next 48 hours of the video so that you don't have to watch commercials. If you love commercials, good, then keep watching all the videos because some of them still have commercials. Otherwise, we will see you on the next video. Bye.
Bye.